So far, we did analysis, variance analysis for direct material, direct labor, and variable manufacturing overhead. So the question is, what we're going to do with the fixed manufacturing overhead, and how we're going to calculate the variances for the fixed manufacturing overhead. Well, in order to do that, we have to go back a little bit and remember how the manufacturing overhead rate was calculated. As you already remember from the job costing, in the beginning of the period, we don't have the manufacturing overhead rate. So we have to come up with some estimation and a way to apply manufacturing overhead during the period. So in the beginning of the period, what we did, we calculating predetermined manufacturing overhead rate. But predetermined manufacturing overhead rate, as you remember, is based on the estimation. So what we're doing is we having as a nominator the total cost, which are estimated for the period of time, which is usually 1 year. And then as a denominator, we have a allocation, cost allocation base, estimation for that allocation base for the same period for which the costs are related. And that's how we come up with the predetermined manufacturing overhead rate. Once we have the predetermined manufacturing overhead rate, we start applying the manufacturing overhead based on the actual usage of the allocation base. Now, the denominator activity, the denominator, which is allocation base, is the activity figure used to compute the predetermined manufacturing overhead. So once we recall, estimated activity level or denominator activity level that has been chosen, it remains unchanged during the period. Even if the actual turns out to be different from the original estimate. So we may have cases when we estimated one usage of allocation base, and in reality, that usage might be different. Now, the predetermined manufacturing overhead has two components. One is related to the variable cost, or that will be the variable component of the predetermined manufacturing overhead. And the other one will be the fixed component, or related to the fixed manufacturing overhead. How are we going to apply? In this case, we have two types of system. In order to understand the fixed manufacturing overhead, we have to understand how the overhead is applied to the working process. So we have two systems. One is the normal cost system, and one is the standard cost system. In the normal cost system, overhead is applied to the working process based on the actual numbers of hours worked in the period. The standard cost system using different approach. In the standard cost system, overhead is applied to working process based on the standard hours allowed for the actual output of the period. So you see there's a slightly difference here. One is based on the actual hours, the other is actually based on the standard hours, which are allowed to produce the actual output or actual products for the period. So again, in the chart, how this is going to look like? We're going to have a normal system where the manufacturing overhead is applied based on the predetermined overhead times the actual hours or actual usage of the allocation base, where in the standards, we still applying the predetermined manufacturing overhead, but that predetermined manufacturing overhead is applied based on the standard hours allowed to reach the actual production for the period. Again, we can have two situations when we have over-applied or under-applied manufacturing overhead. So in that case, the fixed variance will be we're going to have the budget variance and we're going to have a volume variance. Now, why we're looking at the fixed manufacturing overhead variance separately? Because the calculation and analysis on the fixed manufacturing overhead has nothing to do with the direct material analysis, direct labor, or the variable manufacturing overhead. As you already saw, those are somehow related. But on the fixed manufacturing overhead, that's completely different story. So, what we're gonna have here? Here we're gonna have standard fixed overhead rate, standard hours which are allowed for the production, and the last thing is we're gonna have a denominator hours, which denominator hours are used for the calculation of the manufacturing overhead rate. Now the budget variance. The budget variance in this case, it simply shows what's the difference between the actual fixed overhead, which happened during the period, and the budgeted fixed overhead. On the volume variance, that's completely different story now. Volume variance has nothing to do with the spending. The volume variance doesn't show you how much you overspend or underspend, because that's a fixed overhead. The volume variance is going to show you how much you utilizing the capacity or the plant facility that you have available. Let's do something simple. Here, we're going to have two levels of activities. One for 3,000 hours, the other one for 4,000 hours. We're going to, again, we split the overhead in two portions. One will be the variable overhead, the other one will be fixed overhead. As we already know, the variable overhead is based on the machine hours. So variable overhead rate always will be the same, right? Because it is the variable overhead. So variable overhead, how are we going to get it? We're going to divide the total cost, 6,000 divided by 3,000 hours, and that's going to give a $2 variable overhead rate. Same thing with the next one, 8,000 divided by 4, that's $2. Now the overhead rate, the fixed overhead rate per unit, as you remember from the very beginning, more we're using, the rate goes down. On the variable, always stays the same. Rate per unit stays the same. On the fixed overhead, on the fixed cost, more we're using the cost, the rate per unit goes down. Again, the variable overhead is the rate. Rate is the same, $2. But from the fixed overhead, as you can see, more we're using it, because now the cost doesn't change, total cost doesn't change. We're changing the level of activity. Once we change the level of activity, the fixed rate per unit goes down. Now, let's see this example. First, Colaco actual production required 3,200 standard machine hours. Actual fixed overhead was 8,450. The predetermined overhead rate is based on the 3,000 machine hours. So based on the 3,000 machine hours, predetermined overhead rate, as you can see, fixed rate is $3 here. Right? So let's compare first the actual. Well, we budgeted for 3 machine hours, and the fixed overhead per hour is $3. So our total fixed overhead is 9,000. However, the actual overhead is 8,450. That's automatically give us budget variance, which is favorable. So we anticipated $9,000, but in reality, our cost was only 8,450. So that creates $550 favorable spending variance. How are we going to get the other one? Well, obviously, we know how much is our fixed overhead rate per unit, $3, and we know how many actual hours we used. We used 3,200 hours. Because of that, our fixed overhead applied is 9,600 hours based on the 9,000 which we budgeted. So that gives us another favorable volume variance of $600. What the volume variance in this case means? Now, the volume variance is result when the standard hours allowed for the actual input is different than denominator activity. Denominator activity is the number that we're using to calculate the predetermined manufacturing overhead. So what that means? We're going to have unfavorable when the standard hours that we have are less than denominator hours. And favorable when the standard hours are more than denominator hours. So the volume variance, again, it's not going to measure the over or under spending. Volume variance is a result of how we're treating the fixed overhead if it was a variable cost. In this case, let's see if you can do this question together. This company, actual production, are you guys there?
Yes.
So in this company, the actual production for the period required 2,100 standard direct labor hours. Actual fixed overhead for the period was 40,800. The budget, we budget 40,450. Predetermined fixed overhead rate was $7 per direct labor hours. What's the budget variance? Well, the budget variance is the actual minus the budget. Actual cost is 14,800. The budget is 14,450. So what's our budget variance in this case? What will be?
A.
A.
No, B. No, sorry, A.
A, because the actual is higher than what we budget. So we overspent $350, and you're correct. So the next one, same information, but what's the volume variance here now? As we saw, the volume variance, let me go to the volume variance. Volume variance will be the budget, and our budget here is 14,450 compared to the standard hours that we need times the fixed rate. So the standard hours that we need is 2,100. The rate is $7. We budgeted for 14,450. So what will be our volume variance here? We have the standard hours. We have the rate. How much will be 7 times 2,100?
So to get it, we need to multiply 7 per the hours.
2,100, yeah. There's 7 times 2,100. That will be, how much will be that?
14,700.
14,700 minus 14,450.
250.
250. So we're projecting to our spending to be 14,700, but our budget is 14,450. So in this case, we're going to have 250 favorable volume variance. Make sense? In other words, how we're going to do it? That will be our actual. That was the budget. And the fixed overhead apply will be the standard hours that we need times the rate per hour, which will be that much. So in other words, how this works. For 9,000 budget overhead, we anticipated 3,000 hours. Right? But actual went down. So we have the favorable budget variance because we anticipated 9,000. The actual is 8,450. Our capacity, however, our capacity can, through our capacity, we can have 9,600. So you can see this is where our capacity is. This is where we budgeted. This is where we actually are. So what that means, when the volume variance in the standard cost system, the favorable variance are equivalent of the over applied overhead. Unfavorable variance is equivalent of under applied overhead. Now the sum of the overhead variances equals to the under applied overhead for the period. Now the performance report and variance investigation. You always have to have this performance report in order to do analysis on the variable and the fixed overhead. Now, after preparing the performance report, you as a manager still have to decide which variances you should chase. Not all variances worth to you to go and chase them. You should only consider the variances which are high enough in numbers. The other approach will be plot variance, which will be the plot variance. So you're going to have the where there's no variance, and you're going to chase which one is the favorable. You're going to say the range of the standard deviation, but now you're going on the statistics. You're going to set up your range of the standard deviation, and everything above or under the standard deviation, it will be the one that you're going to chase. Now we're going to have two capacities. Capacities is theoretical and practical. Theoretical, as we said for the standards, we have the theoretical capacity, which is the actual potential capacity that we can get. But as we already know, it's impossible you to work on the theoretical capacity. More likely, you're going to work on the practical capacity. Now, the practical capacity represents what can be produced with operations at the theoretical capacity, less any unavoidable downtime. What are the advantages of the standard cost? Standard, when we're applying the standard cost, basically the management, it's perfect and promotes economy and efficiency. It simplifies the bookkeeping and enhances responsibility accounting. What's the potential problem when you go with the standards? The standard cost reports are not fast to produce. They can create a negative impact. And unvalid assumptions, if you don't understand those analyses, unvalid assumptions can break the relationship between you and the employees. When you have a favorable variance, the way we saw with the spending on the price variance, favorable spending, a favorable variance, you can do the misinterpretation. You can see the favorable variance on the price and negative and unfavorable variance on the quantity. on the quality. And then you can misinterpret those ones. Emphasizing on the standards, you can exclude the other important objects. And again, if you want to be on the standards, you have to continuously improve yourself. Again, it's very easy to climb the mountain. It's very hard to stay on the top of the mountain and even to stay even longer on the top of the mountain. Why? Because there's so many people who want to climb the same mountain. There's no space for everybody. So being the top of the standards is very hard to achieve. And it takes a lot of effort, a lot of discipline, and a lot of hard work. You can simply see the tennis players and the #1 tennis player. Everybody wants to be #1, but only one can stay on the top. So the one who's staying on the top, he has to be consistent and he has to continuously improve. Once you go on the top, you cannot stay and relax. It's not going to work. And there's another analysis on the material variance, but those analyses are very interesting because we're going to go with the mix variance, yield variance, and all the other analyses, which are very interesting again. But those will be for the one who's going to continue with the accounting further in their study in Extended School of Management. And that's the chapter for today. This is your analysis to the variances. Any questions at this point?